Hello friends, welcome back to my YouTube channel, and today I have a very interesting topic to share with you, and it's about the mindset shift. And if we pick up this mindset, then we are definitely putting us on a path of growth. So let's deep dive into today's topic. The fact is that only 1% of investor understands this mindset shift. And once you get it, your investing will become calmer, cleaner, and honestly less dramatic. So, most people they would wake up and ask, how do I make maximum money? Whereas Buffett and Munger would ask, how do I avoid doing something stupid that I will lose my money? One big mistake can erase your years of compounding. Definitely knowing how you make money is important. But at the same time, it's important for you to know that how you do not do anything stupid that you lose all your money. Because in investing, you just don't need genius level moves. You need basic mistakes to be avoided for a real long period of time. And that's what we come across this Bollywood line, picture abhi baki hai. Because only if you don't get thrown out of theater early because of some dumb decision, you can watch entire movie. Now, why this mindset shift is very rare? Because most investors want a brilliant strategy, multibagger hunting, timing the market, insider tips, complex indicator. Basically, they want to feel like hero. But Buffett's style of investing is boring. And that's why most people don't do it. People don't want boring wealth. They want exciting wealth. And when they are looking for exciting wealth, sometimes they also get exciting losses. Yeah. So that is the first step why the mindset shift becomes rare. Because most of us are looking out for excitement. Now let me introduce a mental model to you. This is the mental model is an inversion idea which was introduced to the world by Munger. And Munger loved a mental model called inversion. So instead of asking how do I succeed, he said ask how do I fail? And then avoid all those actions. Then don't do that. So the shift is you stop chasing the perfect move. You start avoiding the obvious trap because one big mistake can erase 5 years of compounding. So instead of looking, how do I succeed? Ask yourself, how do I not fail? What do I do so that my actions are not leading me or putting me in a path of a failure? So here are the 7 rules, which are known as not stupid rules of Buffett and Munger. The rule one says, stay in your circle of competence. You don't need to know everything. You don't need to know what you understand. You just need to know what you understand well. And the 1 minute test for this is, can you explain how company makes money in 1 minute? If not, you are not investing. You are sightseeing. Buying a random stock is like ordering food in a language you don't know. Then getting angry that it's a spicy or it's too sour or too sweet. So that's why it's important that you invest within your circle of competence. You don't need to know everything, but you just need to know what you understand well, and that when you're making an investing decision, you are aware of pros and cons of that decision. Rule two is to avoid leverage, basically the fragility killer. Buffett and Munger hate leverage for a reason. Leverage removes time. Even a normal market fall become a disaster if you borrowed money. So avoid margin trading, avoid credit card investing, avoid personal loan to invest. Because leverage does not just increase return, it increases the chances that you get wiped out totally in a volatile market. So ensure that you're not exposing yourself to fragility. Rule 3 is a fewer decision but make them better. Buffett talks about a few great decisions, not 200 average decisions. Most retail investors overtrade, switching funds monthly, buying trend, reacting to news. But a better approach would be to simple diversify your core portfolio. Invest for a long term and make fewer changes in your portfolio. When you don't invest your portfolio, when you don't switch your portfolio multiple times, when you're not constantly tinkering with your portfolio, when you're not going into news driven trade, you are protecting your portfolio. Your portfolio is not a group chat. Adding people every week in the group chat, so adding stock every week to your portfolio will not help you gain higher return. Yeah. So your portfolio is not a group chat. Stop adding people every week. Basically, we are trying to stop adding stocks to your portfolio every week. Rule number 4, temperament beats IQ. In dip, most people panic sell. They stop SIP. They swear never again. The 1% do the opposite. They stay calm and they follow the process. Basically, your behavior is your alpha. Rule 5, margin of safety. Margin of safety means don't buy with zero room for error. Common people, the easiest margin of safety would be don't overpay. Avoid hype. Avoid buying during peak. Don't concentrate too much into one stock, one sector, one job. Keep emergency funds separate. Don't stretch your lifestyle cash flow. It's not just valuation, it's like your life buffer. So ensure there's adequate margin of safety, there's adequate room for error. Rule 6, compounding needs non interference. Buffett's superpower is basically investing at right time and staying invested. Buffett's superpower is not secret tips. It's time plus staying investment. Compounding works when you don't interrupt it with panic. You don't keep switching. You don't chase every shiny things. Let the time do the heavy lifting. Compounding is like a pressure cooker. If you keep opening it to check, you get steam and you don't get result. So allow compounding to do its job. Allow it adequate time to generate return for you. Rule 7. Ego is a real enemy. Bull market make everyone feel smart. Yeah, bull market will give you big returns and everyone will feel smart. But then ego takes over. Bigger bets, riskier trade, I can't lose mindset. Munger's style was brutally honest. Ego is expensive. In investing, humility is a profit tool. So don't let ego make any financial decision for you. Now let's put all of this in action with 1% investor checklist. Before any investment decision, ask, do I understand how this stock makes money? Do I understand how this business makes money? 1 minute test. Am I using leverage? If yes, time for you to stop. Is this a few good decision move or a boredom trade? Reflect. Do I have an emergency fund intact to make to meet my financial to meet my day-to-day needs? If it falls 30%, will I panic? If tomorrow my portfolio goes down 30%, will I panic? Is this within my circle of competence? Is the investing decision within my circle of competence? or I am making decision based on information provided by my friends, relatives, WhatsApp group, Telegram group, or some news article. Am I doing this for return or for ego? Is my investing decision driven by return or is it driven by ego? Answer to this When you answer these questions honestly, you will outperform most people simply by avoiding nonsense. So let's close this with the key mindset shift. Stop trying to be smart. Start trying to be not stupid. And keep these 7 parameters in your mind while making a decision. Circle of competence, no leverage, fewer decision, temperament, margin of safety. Don't interrupt compounding and keep your ego in check. Because these are Buffett and Munger cheat code, which has helped them to generate return for over multiple decades. पच्चर अभी बाकी है मेरे दोस्त, but only if you don't blow up your capital with one heroic mistake. Now, which rule did you, I would like to know from you, from your investing journey, which rule did you break the most? Were you chasing return? Did you overtrade? Where was leverage too tempting for you? Or did you panic sell? Or did you invest without understanding? Let me know in the comment section below where are you struggling and how can I help you. If you know any of your friends who need to build this 1% mindset, do share this video with him or her. And what are your key learnings from this video and how has this helped you in shifting and making correct decision? Let me know that in comment section. Lastly, thank you so much for watching this.